All right, some key takeaways as it relates to accounting. All right, I'm just going to cover some of the highlights here. Accounting for us as small business managers and entrepreneurs is particularly important because that's what outside investors are going to use to evaluate the performance of our business. That's what they're going to use to determine whether they're going to give us $1 million or $5 million or $20 million is based on accounting. The key financial statements that we look at to evaluate our performance are the income statement, the balance sheet, and the statement of cash flows. The income statement, we said, is a look at our performance over a period of time. So like, for example, 12 months versus a balance sheet, which is a snapshot in time. So that gives us a sense of our performance as of a given date. The balance sheet looks at our assets. For example, we said, what are our current assets, which are those that are liquid assets. So it's either cash or it's an asset that can be easily converted to cash in less than a year. Fixed assets are assets that are a year or more, right? It would take a year or more to convert to cash, like a manufacturing facility. If you could sell it at all, right? There's a possibility that you may not be able to sell it. And we said that assets equals liabilities plus owner's equity. We made a distinction between a cash basis and accrual basis of accounting. We have to choose. It's either or, not both. Then you get into problems, right, Murad? That would be, you can't do cash basis and accrual. Cash basis is, it says that we document the transaction when we pay the cash. So it's when we pay the plumber, it's when we pay the supplier. Accrual accounting, what's accrual accounting, Murad? Tell us.
Let me see if I remember. We record our revenues when we earn them, and you incur expenses when we record expenses when we incur them.
Right, so you may not have paid the money yet, but you record the transactions when they incurred, when they were incurred. Two very different ways of accounting. And we're not trying to fool anybody, we're not trying to trick anybody. Ultimately, we need to know our financial performance. We need to know whether or not we're achieving our goals or not. Whether we're increasing sales, whether our profits are increasing. We need to manage that very carefully. Now there's also a number of ratios that we could calculate. Profitability ratios, liquidity ratios, activity ratios, and leverage ratios. Profitability, liquidity, activity, and leverage ratios. Those are ratios that we calculate to track our performance. So for example, we talked about return on sales, which we said is net income over net sales. Earnings per share is also a profitability ratio. which is net income over the average shares outstanding. For return on sales, best in class, right, if we're going to benchmark ourselves versus other companies, is roughly 15%. Doesn't mean it can't be higher than that, but that's the kind of performance that, for example, Johnson & Johnson has been able to achieve consistently. Sarah?
We have to memorize all of these different ratios and actually like what they mean.
No, you don't need to calculate the ratios, but you need to identify what they are. So what are the different types of financial ratios, right? The profitability ratios, the liquidity ratios, and so forth.
We would need to know how to, like, net income over.
No, you don't need to know the formula.